This is Wall Street Week. I'm David Weston, bringing you stories of capitalism. This week, trade is at the center of President Trump's economic policy. We bring you the story of what he's trying to accomplish and whether he's likely to succeed. Plus, Vanguard celebrates the 50th anniversary of its first fund. We'll go to its headquarters in Pennsylvania to hear from CEO Salim Ramji about what he thinks they've accomplished so far and where they go next. And birth rates are dropping through much of the world, with governments at a loss for what to do about them. We bring you the story of what one Japanese company has done to ensure it has a workforce for the future. But first, we visit the complicated world of Jay Powell, caught between a slowing economy, stubborn inflation, and a president who can't quite decide what he wants to do with the Fed chair.
And inflation is basically down, and interest rates came down despite the fact that I have a Fed person who's not really doing a good job, but I won't say that. I want to be very nice. I want to be very nice and respectful to the Fed. You're not supposed to criticize the Fed. You're supposed to let him do his own thing, but I know much more than he does about interest rates, believe me.
Larry, we have FOMC meetings next week. What do you expect the Fed to do?
I'd be very surprised if they moved interest rates. I think they'll continue to convey vigilance and a sense of uncertainty about where the economy is and their determination to monitor both the cyclical risks and the inflation risks. I think the Fed has to be very careful given all the political pressures that have been put on it, given that the tariffs are potentially going to be an important inflationary impulse in the economy, and also given the substantial signs that the economy is slowing. If I were at the Fed, I would be trying to have an uneventful meeting and not produce any substantial reaction in the markets. And my guess is that that will be their course.
President Trump seems to have a different view. He thinks that they should have cut already, that they're behind on the cut. And there is some slowing in the economy. We saw the GDP numbers, at least for the first quarter, come in light. We saw core PCE actually pretty modest this week. Is there a growing case for what President Trump is arguing for?
I think the economy probably looks softer today than it did a couple months ago, but I think there are also some troubling signs of inflation risk going up. I wouldn't argue with the market's judgment that the full set of developments in the economy points towards more easing than looked like it would be necessary a month or two ago. But I think it would have been a grave mistake to have eased already, and would be a very serious error to ease at this upcoming meeting. I think the results would be a lack of confidence in the Fed's determination on inflation, and that would mean higher interest rates at the long end, and that would mean higher mortgage rates, and would probably ultimately mean more economic weakness. So I think the president's advice is really quite misguided, both as to the substance and as to the appearances. I've said many times, Fed bashing for a president is a fool's game. The Fed doesn't listen, and so short-term interest rates don't go down. The market does listen, and so long-term interest rates go up.
Talking about short-term interest rates, we had Treasury Secretary Lawrence this week say that if you look at it, the short rates are below the federal funds rates right now. And when the short rates are below the federal funds rates, that really argues for a cut. Is that a good benchmark?
I don't think so. The two-year interest rate reflects the expectations of what the future short-term rates are going to be. So all that's really saying is that the market is expecting that there will be cuts. That's not the same thing as saying there should be cuts. So I think it's pretty analytically unsound to reason from the 2-year to what the Fed should do, and it's pretty inappropriate for the Treasury Secretary to be commenting in that way on the Fed. In many ways, it's actually even worse than the president commenting, because people understand that presidents are political figures who are called on to address all issues, whereas they think of secretaries of the Treasury as sophisticated financial professionals who should know all about the independence of the Fed.
The independence of the Federal Reserve doesn't depend on the will of the president alone. Congress set it up that way, and ultimately the courts may have something to say about it. Kathryn Judge is a professor at Columbia Law School and has studied how the Fed has evolved.
So it was actually restructured quite significantly in 1935 to be significantly more independent. That year matters, actually. It was right after the Supreme Court decided a major decision, Humphrey's executor, which made it clear that Congress was able to create independent agencies. And it was in the wake of that decision that the Congress really restructured the Fed to its current structure. And it's a complicated structure. We still have 12 reserve banks across the different country. But then we have the Board of Governors, and they all serve for 14-year terms, and they can only be removed for cause. And that really serves as the bedrock of the Fed's independence.
There have been times, even in more recent history, when the Federal Reserve seems to have been really addressing the concerns of the president. Under President Nixon, for example, that certainly happened.
Yes.
What were the consequences of that, and what corrected and what gave us Volcker?
Yeah, I mean, I think it was actually what happened with Nixon and Arthur Burns, who was then the Fed chair, that led to the Volcker era, and really what we've had subsequent to the Volcker era, which has been a real respect among politicians for Fed independence. And what we saw there is the classic stereotype of a president who wants a slightly healthier economy in the short run, is putting pressure on the Fed chair, and a Fed chair who felt the need to be somewhat accommodative to those pressures. And the result was really destabilizing. We ended up with a period of meaningful stagflation. So we had high rates of inflation, high rates of employment. It was not healthy for really the economy or for anyone else within the economy longer term. And one of the real challenges then was, how does the Fed re-establish credibility? How does the Fed convince the public, convince markets that it is going to tighten monetary policy even when it's facing pressure to be more accommodative? And Volcker really came in, took the reins, and had that long-term objective, and was willing to cause some significant short-term economic pain and to face some meaningful threats in the process. But he managed to do a remarkable job reestablishing the Fed's credibility.
Recent presidents in general have been reluctant to comment on the actions, particularly in monetary policy, of the Federal Reserve. President Trump has been very explicit, saying, I can say what I want to say. If I want to comment on it, I'm going to comment on it. Can he be free to, I'll say, jawbone the Federal Reserve, consistent with its independence?
I would say that's part of what we're trying to figure out right now. The challenge that we're facing with President Trump is not just that he has an opinion on interest rates. I think it's actually legitimate, and even though it's not been done in recent presidencies, not inappropriate for a president to be able to have a view. The challenge is he's expressing that view while also having taken the position that he has the authority to fire Jerome Powell, the current chair of the Federal Reserve, and while also having removed other commissioners from other agencies that have explicit for-cause removal protection. So it really is that combination of not only having an opinion, but having views about his legal authority that are incredibly expansive, that have the potential to really undermine the credibility and that expectation that the Federal Reserve will be able to maintain the independence that it's enjoyed, and that has allowed the economic flourishing that the country has enjoyed for the last 4 decades.
If we are looking for guardrails, do they come from laws? We like to say we're a nation of laws, not of men. Or might they come from bonds? Because there's been a fair amount of reaction in the bond market to some of what President Trump has said.
I was going to say, and I have to say, I've personally welcomed all of those reactions, and I think it's inappropriate for a president to be responsive to understanding what the market is telling them about the likely impact and the potential destabilizing impact of policy choices, of threats. That being said, we can't rely on the bond markets alone, and there's a lot of danger in that having be too much of an indicator or too much of an influence.
Coming up, tariffs may be President Trump's favorite word, but much of the world seems to have problems with it. We examine what U.S. trade policy can accomplish and what tools are fit for purpose. That's next on Wall Street Week. This is a story about means and ends. At this point, we all know the means President Trump has chosen to advance his economic agenda.
Tariff, tariff, tariff. I am a tariff man.
To me, the most beautiful word in the dictionary is tariff.
But if tariffs are the means, it's not always as clear what ends he hopes to accomplish with them, which makes it harder to evaluate whether he's winning or losing.
Tariffs are about making America rich again and making America great again, and it's happening, and it will happen rather quickly.
All of us are becoming fluent in the talk of U.S. trade policy, whether we want to or not. But in the end, what is it that trade policy is meant to accomplish for the America the president wants to make great again?
So the goal of trade policy, I think, should be enhancing economic well-being in the United States and internationally, because you should be able to use trade as part of an economic strategy that grows an economic pie.
Susan Schwab served as the U.S. trade representative under President George W. Bush and now teaches international trade at the University of Maryland School of Public Policy.
This is not a zero-sum exercise where I win, you lose. It should be you grow the economic pie. It is a policy where you create rules of the road and then you enforce them rigorously. It is a policy where you make sure that as you build those rules, they are rules that, again, my opinion and historically our view of trade, trade barriers are sort of the last result. You know, free trade, open trade, market-based trade is the norm, is what the goal, where you'd like to be. But reality is deviations from that norm. And you want to minimize the trade distorting interventions in the market. You want to use trade in the most positive sense, but you also need to be defensive because you don't want trade distortions to undermine your national security interests, the economic well-being of your population. But you don't want to pretend that trade is the be-all and end-all and that it's going to cure everything.
Free trade has gotten a bad name in some parts of Washington these days. And the accusation, I think, is that it has actually hurt some workers in some industries, at least in parts of the country. Is that fair?
Much as I hate to say it, I don't think we've ever had free trade. I don't think any country, no matter how pure they think they are is actually a free trader. Trade can impact, can hurt, and has hurt different communities, different individuals. And the question is, how much of that is, quote, structural? You know, how much of that is, I'm not sure that Americans ever want to make labor-intensive footwear or labor-intensive apparel again. And how much of that is unfairly traded imports that have been subsidized, that are dumped into the market, that are selling at less than the cost of production. I'll give you an example. In the 1790s, over 90% of the proportion of U.S. workers were in agriculture. Today, that's what, less than 2%, less than 3%. Nobody argues that U.S. agriculture is uncompetitive. U.S. agriculture is a major competitive producer, but we do it without the same proportion of labor needed. Productivity enhancements, technology has taken over that function.
And that has been a foundation of President Trump's trade policy, making America great again by quite literally making stuff in America again.
People claim we don't make things anymore. In fact, we make things all over the country, and manufacturing output in the United States has continued to go up and up and up and up, contrary to what a lot of our politicians say, Republicans and Democrats, by the way. Manufacturing employment has gone down, has been going down since the 1950s, in part because more automation, more technology, but also in part, if you talk about, for example, the China shock, late 1990s into the 2010, 2011, there was no time for structural adjustment, no time for the workers to adjust, and workers and communities were severely impacted. Their non-market economy model is a bad model, and they're exporting their economic mistakes. So they have overcapacity, and they're dumping them all over the world.
China's non-market economy may be a bad model, but it doesn't look like they're going to move off of it anytime soon. So in the meantime, what do you do with a non-market economy as big and as powerful as China?
We should be doing a much better job of enforcing existing rules at the WTO. Running up the score against them puts us in a much better position to make the point they are sinners, right? So that's the first thing. The second thing is we need to be working with our trading partners to get them to stop, to block, let's say, block their exports of those dumped and subsidized goods.
I'm not sure that President Trump seems to be pursuing a route to getting our trading partners on side thus far. How could one do that might be somewhat different from what we're seeing right now?
Well, you've got, we talk a lot about tariffs, and it only seems to be in terms of raising them. And we talk about reciprocity.
President Trump's tariffs have begun to take effect. Customs duties jumped 60% in April to an all-time high of more than $15 billion, a number that does not yet include the universal 10% tariff introduced on April 2nd. But Schwab believes reciprocal tariffs aren't a means to an end.
The reciprocity thing, I don't think works, but I do think that you can get to yes in trade agreements where you have a more comprehensive scope. The key thing, I believe, is not to have a trade policy that renders your own production uncompetitive, because 95% of the world's consumers are outside this border. If you put up trade barriers against the wrong things, like inputs, because over half of what we import are actually inputs to our manufacturing, then you're going to make what we manufacture uncompetitive, and we can't export them.
If the goal is to have competitive industries, can we have competitive industries without competing? That is to say, by protecting our industries from competition from abroad.
I don't think so. Or let's say that the history of that is would make one doubtful. So if you think about our auto sector, domestic automakers in the late 70s, early 80s, came in for a really big shock when the Japanese autos arrived on these shores, and our automakers had not been exporters. And they met their competition on these shores for the first time and discovered that Americans wanted to buy Japanese autos that had fewer errors, that had features that their U.S. automakers had not seen fit to add.
It's not just Schwab citing the example of the Japanese automakers of the 1990s.
One thing would be to say, we're just not letting anything come into the United States. And that would mean that as of like the 1990s, we would have lost the benefits of all these things that were discovered in Japan about just-in-time manufacturing and statistical quality control, higher quality vehicles.
Paul Romer is a Nobel laureate and former World Bank chief economist.
What we did then was, instead of saying, okay, we're just cutting off any connection with Japan, we'll live with our cars the way we are, we said, you can take what you know, but you have to set up auto plants and hire workers here in the United States. So the ideas about how to make new quality cars come in. They can be used to compete with the existing firms.
Romer now leads the newly formed Center for the Economics of Ideas at Boston College.
My whole work has all been about ideas versus objects. So I started playing with, well, what if we had restrictions on flows of objects, but didn't restrict the flows of ideas?
So what would happen? Take the solar industry, for example.
Those solar panels have gotten much cheaper because of the subsidies provided by the Chinese government to increase output. And so, quote, they control that industry, but they've made solar electricity way cheaper all around the world. But then the question is, how do we respond? I think it's a bad policy to try and protect like an industry or a firm with a tariff barrier. But it's okay if some government wants to subsidize something. And if they're subsidizing solar panels so aggressively that we don't even want to get in that game, fine, we can go do batteries or, stationary batteries, electrical system sized batteries, or, 100 other things. But the point of this distinction of ideas and objects is that new ideas, fly-by-wire, cheaper solar panels, those new ideas are really valuable. And we should have governments subsidizing them. We shouldn't be so worried about trying to punish the other guys for doing what we would really like to be able to do.
But do you tell China, fine, subsidize your solar panels, but come make some of them onshore?
That's what I'd say. Yeah, exactly. So we could invite in all of that kind of expertise, but say realistically to people in the United States, there'll be jobs for you, like the people you knew in Flint. There'll be a future for you. Now let me step back and say, I'm trying to describe a policy we could evaluate. It's got some costs, it's got some benefits. Not everybody is going to agree that this is the best one. But what's missing at the moment is nobody's even said, what's the policy? So we don't even know how to total up the costs and benefits.
President Trump argues his tariffs will make America richer. But which parts of America? Romer says a sound trade policy is one that benefits all Americans.
I think a good way to think about this is we want the average income, like GDP per capita, to grow, but we also want to share that relatively evenly, at least in the sense that everybody can expect some growth along with growth for the nation. We've always known as economists that the downside of free trade, even though it's good at raising average income, is that it can widen income inequality. And we always said, well, don't worry about it. There's ways to redistribute the gains so everybody's a winner. But redistributing the gains is not that easy, and we haven't done it.
The answer, according to Romer, lies not just in tariffs and balance sheets, but in the exchange of ideas.
If BYD says, we're happy to make our cars in the United States when we sell them in the United States, will you let us come in and use what we know and make and sell cars in the United States? If they say yes, then I think it's probably going to be an okay policy. If they say no, then we're kind of back in that move towards autarky, and I'd be worried about where that goes. I think all of history shows us that autarky is really, it's just a terrible trap. And it's a trap because you fail to realize how far behind you're getting, because you're not getting the daily confrontation with, wow, like that Japanese car really is a lot better than the rattle trap I've been driving. So you need the direct confrontation with that. And boy, Tom Friedman has been making this point about right now, people in the United States do not understand how rapidly China is progressing in things like semiconductors, because we're just not being confronted with it enough on a daily basis. People I talk to in the semiconductor industry are saying, they're moving very rapidly, but we need to be confronted on a daily basis, and we need everybody to face the threat of competition. If somebody can come in and do it better, that's fine if it's from outside or from inside, but let's just use domestic labor to build the thing.
Up next, Vanguard is celebrating the 50th anniversary of its first fund. Its CEO takes us through how it got to where it is and what comes next. This is a story about going with the flow. Whatever the pluses and minuses of trying to beat the market when it's reasonably stable, at a time when it's swinging wildly, risk is out and safety is in. That's the philosophy that gave rise to passive investing a half-century ago. Katie Greifeld brings us the story of Vanguard, marking the 50th anniversary of its creating the first fund, as it's ridden the wave rather than trying to beat it.
I don't want anything, but sometimes you have to take medicine to fix something.
Markets entered a period of extreme volatility at the beginning of last month after President Trump announced expansive tariffs on allies and adversaries alike. In the 2 days that followed the so-called Liberation Day on April 2nd, the S&P 500 fell by over 10%. By the end of the following week, that amounted to $10 trillion in losses globally. But there were bright spots, among them ETFs. The week after the announcement, ETFs saw net inflows of more than $35 billion.
We had about 4 of our 5 highest trade days in our history in the past 6 or 8 weeks. In every case, clients were buying rather than selling. And in each of those cases, they were going back to these original principles of diversification, staying aligned with your goals, and investing for the long term.
Salim Ramji is the CEO of Vanguard, which has been battle-testing its approach to investing for half a century.
So some of it just comes from kind of our clients' behaviors, and as I said, whether we're attracting clients who like what we stand for. In many cases, it's they're exposed to individual securities, and they're seeing the risk and volatility in owning individual names, and they're looking for a much more diversified set of exposures. But the biggest part of clients' portfolios are often individual securities. And so there's a lot of money coming in from clients who want more diversification than they might get from owning individual stocks and bonds.
In the 50 years since Jack Bogle founded the company, Vanguard has seen 6 recessions in the U.S., including the dot-com bubble, the GFC, and more recently, the COVID-19 recession.
Let me give a shout out to Vanguard. They created indexing for the individual investor.
David Booth has been part of the evolution of indexing since day one. He was around for the early days, working with pioneer Eugene Fama.
We were all kind of friendly and, worked with each other to the point that the group I worked on at Wells Fargo, which was one of the first, came out with one of the first passive funds, first index funds. Jack had created the framework for providing indexing to individuals.
Bogle was the legendary founder of Vanguard, who went against what was then the investing grain.
How to decide on the funds is a little bit difficult. I'd say taking the most important part, perhaps the equity fund selection. I think a beginning investor in particular should go for sort of middle-of-the-road funds like fairly conservative growth and income funds or growth funds, and even, as suggested by your remarks at the outset, maybe a little seasoning of index funds wouldn't be so bad.
Described you as an industry statesman.
When Bogle appeared on Wall Street Week with Louis Rukeyser in the early 90s, Vanguard had around $100 billion in assets under management. Today, it's grown to more than $10 trillion. And through the growth, Bogle's philosophy remains.
Well, you have a really interesting job because, you have to thread staying true to the roots that Jack Bogle laid down 50 years ago, but also positioning Vanguard for the future and, future-proofing Vanguard.
Yeah, I think first is understanding our history and understanding our culture. And I've also benefited that first, Bogle wrote a lot. And so not just in his books, but in all the historical archives and speeches and in the memos and the like.
He was a quote machine.
One of Bogle's famous sayings tells the story of passive investing. Don't look for the needle in the haystack, just buy the haystack. It's a philosophy so popular, it generated an online following of passive investors known as Bogleheads.
One of the interesting things is Vanguard's always changed. Like, we've maintained our sense of consistency around our purpose. Whether you can think about our moves into advice, our moves into ETFs, our moves into, if you go back into the 90s, our moves into retirement. These were all changes in the business model. But so I sort of look at what I'm here to do is to continue that tradition and that kind of duality between staying true to the purpose and also changing things as we need to change and adapt based on our client needs.
Buying that haystack today looks a little different than it did during Bogle's days. But Vanguard makes no apology for sticking to its tried and true approach to indexing that avoids the trends of the day.
You could start to have to really think about how do you stay true to the roots while also, giving clients what they want. Because those clients, specifically in advice and wealth management, I could imagine them requesting private assets, which I know that Vanguard is pursuing, but I could also see them asking for Bitcoin and crypto, which famously Vanguard isn't too hot on. So I wonder how you're thinking about those sort of potential run-ins.
We're not going to be everything to everybody, and that's okay with us. That's been true for kind of the history of the firm. But where we see opportunities to partner with others, including in things like private markets, and we think it's good for clients' long-term portfolios, we'll absolutely do it.
So it sounds like that's a no. Like if a client came to you and said, I really want to add Bitcoin, or I really like the looks of this leveraged single stock ETF. It sounds like that's not a road that Vanguard is going to go down.
Yeah, we're always going to be focused on what we think is a good way to build long-term wealth. and that is suited to the client's individual needs. And so that may mean saying no, or saying that we don't think that particular product and that particular offering is right for the client. And we may not get caught up in the latest fad, but we're dependable for the long term.
Your comparative advantage is not going home at night and trying to think of the next big winner. Your comparative advantage is going home, figuring out, here's my circumstance. I just decided to retire, or I won the lottery, or whatever the changes are. How does that impact the way I want to invest? That makes a lot of sense. And spend the rest of your time playing with the kids. That's kind of a side benefit of all of this. You can come up with sensible investment solutions that have a great chance of winning over the long haul without getting just emotionally fixated on it.
Vanguard is known for making diversification easier for investors through indexing, but also making it cheap. In February, it announced its 2,000th and largest ever fee reduction, cutting its average asset-weighted expense ratio to just 7 basis points. That compares to the industry average of 44 basis points.
We're always investing back into technology and into capabilities that enhance our economies of scale. It's true in our investment team, it's true across the firm, because there are lots of advances, as you can imagine, that are just making investing kind of easier, making it more efficient, and we need to be at the forefront of that. Back in February, we announced kind of record fee reductions, but it was the 2,000th time we'd done that, right? So it was a very Vanguard kind of oriented thing. And when we think about kind of the future, we just see so many opportunities to extend the Vanguard effect, whether it's in fixed income, whether it's in things like cash, whether it's in things like advice.
Its competitors have been forced to keep up with the race to the bottom in the fee war, or to find other ways to differentiate themselves.
It's one thing to say, look, I have slightly higher fees, but that only works if what really counts is what your return is. And we now have 43 years of performance that's showing that this kind of approach can work.
Over its 50 years, Vanguard has changed investment management, but it has also evolved to meet investors' appetite for new products and services. In mid-April, Blackstone came out and said that it had teamed up with you and Wellington to build investment combinations with stocks, bonds, and alts, which is interesting. Private markets have been the talk of the town for months yet now, and it seems like every issuer is trying to figure out how to incorporate that into their strategies. Why go that direction?
Well, going the partnership route was, if I will, a very Vanguard thing to do. Mm-hmm. The first Vanguard funds 50 years ago were managed by Wellington. And it was actually Jean Hines over at Wellington, the CEO. She came with this idea around, could we partner with another firm that does private markets as well as Wellington does fundamental equities, as well as we do things like index and active fixed income. And this idea of going the partnership route was, as I said, something that we've done for 50 years now. We have plenty of other active equity managers. Wellington is our longest standing and largest. But when we started to think about how do we branch into private assets on behalf of our clients, it was really that Wellington came up with the kind of the idea and the proposal. And that was really the beginnings of, I think, what you've heard about.
ETFs are meant to diversify risk and make investing safer for retail investors, but indexing might be creating another kind of risk.
It's got the point now with ETFs that they've kind of created this giant investment casino. Here's how you can place your bets. You've got all these indices, you can put some money over here and time. Because the question often comes up is, well, if everybody indexes, won't markets become inefficient? And so now people, instead of picking stocks, they place their bets on indices. I mean, I hope, and I think that's unfortunate, because now you're back into the same soup that you were in before, which is, in order to beat the market, you've got to pick the right indices at the right time.
The growth in ETFs has brought with it competition for mainstays, like Vanguard. Which competitor do you think about the most, and why is it BlackRock?
The competitor I think about the most is friction. Mm-hmm. The biggest impediment, I think, to clients achieving the kind of investment success that we would hope for is that investing is still too complicated. And there are ways that we're always looking for to how do you make it easier? How do you make it easier to open an account, to fund an account?
10 years from now, when it's Vanguard's 60th anniversary and we're sitting here again, what do you want to have accomplished?
Vanguard plays a really unique role in the investment community because of our client ownership, because of our focus on giving people a fair deal. And I certainly don't want that to change in 10 years. I don't want that to change in 20 years or 30 years or well into the future.
Up next, what to do about the dwindling population throughout much of the world, from China to Japan to Europe. The story of one Japanese company and what it's done to encourage employees to have babies. This is a story about people and why we may not have enough of them. Falling birth rates around the world threaten economic growth, even as the Trump administration weighs a possible $5,000 baby bonus for new mothers. We turn to Asia, where our colleague Sherry An reports from Seoul on what works and what doesn't.
A population meltdown. That's what lies ahead for South Korea and other parts of East Asia if the current trajectory doesn't budge.
연금을 내야 될 사람보다 연금을 타야 될 사람들이 많아지니까
그러니까 일과 가정을 같이 유지를 잘 해내고 싶기는 한데 사실 쉽지는 않거든요.
그때 우리 위기가 굉장히 심각했다고 생각을 하는데
Dr. Lee Sang-nim is a leading population studies expert who's been sounding the alarm on South Korea's looming existential crisis. Although its total fertility rate rose to 0.75 or about 238,000 births last year, a slight uptick from the year before, South Korea still has the world's lowest fertility rate.
근데 이걸 반등이라고 사람들이 보기에는 사람도 있는데 저는 반등보다는 출산이 좀 멈춘 거다. 그러니까 하락세가 멈춘 거다라고 보는 게 일시적으로 멈춘 거라고 보는 게 좀 맞을 것 같아요. 이건 또 뒤에 낳을 아이를 끌어오는 측면도 있어요. 속도를 좀 빨리 한 측면도 있기 때문에 가장 중요한 거는 청년들이 아이를 낳고 싶은데 못 낳는 요거를 해야 되는 게 아니라 요 안 낳는 요 수준을 놀려놔야 돼. 아직까지 거기까지 이르지 못했죠.
For any economy to sustain growth, they need to be either more productive or have more people. But over half of the world's economies are seeing birth rates falling below the replacement level of 2.1. This downward trend already impacts sectors like healthcare, pensions, education, the military, and various industries that are reliant on domestic consumption. So how did South Korea get here?
한국의 출산율을 이해하려면 2000년부터의 이해가 필요한데요. 왜 이때 생겼냐면은 97년 연말에 그 글로벌 위기, 금융 위기가 있었잖아요. 그러면서 그 여파가 뒤에 오면서 이제 청년의 삶이 불안정해지고 정리해고가 되고 그렇게 되면서 청년이 결혼과 출산을 미루는 위기적 저출산이 시작이 그때부터예요.
He attributes the decline to three main factors.
하나는 경제적 요인이다. 지금 당장 아이를 키우는데 저는 경제적 비용의 문제가 있겠고요. 두 번째는 구조적 요인인데 주거 문제, 일자리 문제. 그 이면에는 청년들이 살아온 과정 속에서 쌓여있는 인식의 문제들이 있다고 생각합니다. 청년들이 특히 가족의 소중함을 덜 느껴요. 그 경험도가 굉장히 낮기 때문에.
This value is exactly what one politician is hoping to instill in young people through matchmaking events and other programs.
예, 안녕하세요.
Mayor Shin Sang-jin has been branded the Mayor of Love. He matched this couple at a city-sponsored event last year.
청첩장. 와, 윤수민 씨, 김설아 씨 축하해요.
바로 이제 아이를 계획하고 있습니다. 말띠 아이가 될 걸로 예상하고 있습니다. 예.
우리가 도시 차원에서 해결하기 위한 노력이 또한 중요하다 생각을 해서 우리 한국의 많은 청춘 남녀들은 이 결혼에 대해서 별로 시급하게 중요하게 생각들을 안 하고 있어요. 그러니까 한 50% 가까이는 결혼은 해도 되고 안 해도 되는 이런 좀 생각이기 때문에 결혼에 대한 인식 개선과 또 실제 청춘 남녀가 만나서 서로 좋아하는 사람끼리 사랑하고 결혼하는 이제 그러한 좀 분위기를 환경을 만들어주는 것도 우리 기성세대, 우리 정치 또 지자체에서 할 일이다 이렇게 판단을 하고 있습니다.
성남시는 좀 이 면을 볼 게 좀 많아요. 그래가지고 네커플한 거는 바보짓이죠. 근데 지자체, 그러니까 뭔가 이제 압박이 크기 때문에 지자체가 뭔가 해야 된다는 느낌이 하나 있고요.
Even the mayor admits that marriage is only a small part in solving the issue of low birth rates, and government initiatives haven't made much of a dent.
이 우리나라의 저출산 정책은 그거의 그 정책을 받아야 되는 그 대상자, 당사자들이 실제 무슨 정책이 어떻게 있는지도 알기 어려울 정도로 모든 그 정부 부처마다 수많은 정책들이 있습니다. 저는 굉장히 다 한 일이 없다, 부정적이다, 하는 형식에 불과하다, 이렇게 저는 냉정한 평가를 합니다.
When it comes to what can be done, the other focus is on the private sector.
2024년도부터 운영을 하고 있는데 자녀가 출산을 하면 아이 한 명당 1억 원씩 그렇게 지급을 하는 제도입니다. 총 98억 원을 현재까지 지급을 하였습니다.
Ouram is Deputy HR Director at Puyong Group, a construction giant known for its large-scale residential projects. It was founded in 1983 and employs about 2,500 workers.
아무래도 지금 현재 가장 큰 국가적 문제는 저출산 문제 아니겠어요? 이 저출산이 계속 지속이 돼서 회장님께서는 한 20년 후가 되면 경제 생산 인구, 그리고 국가 안보, 국가 질서 유지 등에 필요한 이런 국방 인력이라든지 국가 존립을 저해하고 위협하는 그런 요소가 될 수 있기 때문에 지금부터 대비하지 않으면 큰 위기가 올 수 있다라는 절박함과 책임감이 아마 지금의 출산장려금까지 결정을 하시게 된 계기가 아니었나 생각을 하고 있습니다.
총 저는 2억 원을 수령하게 되었습니다. 바로 통장에 1억씩, 매년 1억씩 들어오는 게 저한테는 엄청난 체감이 되어서 너무 감사히 생각하고 열심히 일하고 있습니다.
35-year-old Min Ji-yeon works in the finance department. She says she's considering a third child to take advantage of another company benefit.
저희 회장님께서 이제 아이 셋을 낳으면 이제 그 영구 임대 주택을 제공하겠다는 말씀도 하셔가지고 우리가 셋째를 낳으면 정말 이 주거에 대한 문제가 해결될 수 있겠구나라는 생각도 조금은 들었거든요. 저희 회사는 9시부터 6시까지 무조건 정규 근무를 하고 있어요. 그런데 아무래도 아이가 갑자기 아플 때도 있고 혹시나 무슨 일이 있을 때도 있는데 좀 유연하게 근무 시간이 변경되지 않는 게 조금은 아쉽더라고요. 만약에 하나 더 해주신다면은 근무 시간이 조금 유연화되는 것 정도 좀 바라고 있습니다.
Across the sea, one Japanese company is focused on just that, a better work-life balance. While South Korea has the world's lowest birth rate, Japan is home to the oldest population. Faced with labor shortages and declining labor productivity, Japanese trading giant Itochu took matters into its own hands.
2010年に岡藤正弘現在の会長 CEO ですが、岡藤が社長に就任した時に始めた改革です。その時の大きな目標として少ない人員で競争していこうと、それを担っていたのが私でございまして、岡藤からの宿題に四苦八苦しながら現在まで働いてきたというところであります。
Fumihiko Kobayashi is the executive vice president at Itochu and has been at the company for 45 years.
私の若い頃はその総合商社という業界というのはブラックだと言われていました。ほとんどの人が深夜まで働いていて、土曜日日曜日を分かたず世界中の時差を苦しみながら、現在はそのようなことは一切なくて、当社では朝方勤務に切り替えてからは夜8時以降残業は禁止にしていますので、夜遅く働いている人はいません。2010年の改革を始めた時から比べますと、現在までにはその生産性は5倍以上に拡大しております。利益も5倍ぐらいに拡大しておりますし、 配当も当時から比べれば11倍までに拡大して株価も8倍9倍まで成長していると。
Along with this momentum, Itochu noticed an added, unexpected benefit.
当社のお医者さんですけどね、がある時に、ちょっと見てほしいものがあると。それは、当社の女子社員の出生率が 1.97 ですという結果になっていました。当時の日本の総平均は 1.3 程度、東京都は 1.1 程度と。当社の出生率は数年前まで 0.6 だったのが伸びたと。2012年から2015年ぐらいまでの間に、大きくジャンプアップしています。その時に当社の働き方改革で一番大きな改革を行った時でした。朝方勤務という働き方でありました。
These results have caught the attention of Japanese lawmakers and others abroad.
韓国に行ってご説明したんですが、なぜ伊藤忠商事のこの政策が出生率を伸ばすことになったんでしょうかというような質問を受けました。おそらく女性を対象にした政策ではないということです。女性を働かせやすくしよう、お休みしやすくしようというような政策に、フォーカスしがちでありますけれども、全ての人が働きやすい、働き続けられる環境を作り、そのことが一つのキーではないかと思います。男女ともに双方が働き続けられる環境を作るという政策でなければ少子化には寄与できないのではないかというふうに考えています。
Kobayashi says companies have a leg up over governments because they can act fast.
企業というのはみんな競争するんです。政府は競争しないですよ。民間みんな競争する。例えば伊藤忠があんなことやったらうちはもっといいことができるんだというふうにみんな競争し合うので、そのスピードはどんどんスピードアップされていくだろうと思います。
그렇기 때문에 여기에 대해서 기업이 참여하는 건 사회적 책무를 진다는 의미에서 모든 이 변화는 정부뿐만 아니라 기업과 다른 시역, 시민사회, 지역, 정부, 정당에서 같이 다 가야 되는 문제입니다. 그 중에 한 팩토로서 의미가 있다고 생각이 듭니다. 특히 일가정 양립의 문제를 못했다는 그런 나라들, 특히 동아시아 국가들에서는 기업의 역할이 굉장히 중요하다고 생각됩니다.
Coming up, the story of dimensional fund advisors and how a group of professors at Chicago married big data with computers to produce a fund that manages some $700 billion for sophisticated investors. David Booth studied business at the University of Chicago under three economists, Eugene Fama, Merton Miller, and Myron Scholes, all of whom would go on to win Nobel Prizes. He took their work on markets using big data and computing power and turned it into dimensional fund advisors. And the rest, as they say, is history.
Well, there was a revolution in finance, and particularly investing, really in the 60s and 70s. That's gone largely, unnoticed. And I was in school at the time, in 1969 at the University of Chicago, and got hit with all this new way of thinking and all this new research. Before 1960, you couldn't really do much research because you didn't have the data and computers weren't big enough. That all changed in the 60s, and a lot of great research came out, and it changed the way academics think about investing. I think a lot of people think that in order to get ahead, you have to be smarter and work harder than the next guy, and that will enable you to pick stocks better. And it turns out, testing that out, there's not much evidence that that's true, which came as a shock. The market itself does a pretty good job of pricing to the point where it's very difficult to find market misprices and so forth. So that was the revolution of thinking. And the good news is you don't have to do any of that to have a good experience, because what was developed, I think this is the 50th anniversary of Vanguard's index fund. You can just buy market portfolios like Vanguard does and we do, and over the long haul, those are going to perform pretty well.
As you said, there was a revolution. Part of that was index investing, because before that it didn't exist. Could it have existed without computers, or was it a technological development before it was a financial development?
It was a technology, yeah, right. In fact, that ties into my own personal story, which is you have all this great academic research. The current way people invest is not a very good way to do it. So the question popped up, okay, well then what are you supposed to do? And that's still, even today, the part of the question. Well, one idea was to just simply index a market, a stock market or a bond market or whatever. And that sprang up as a result of all this research. Keep in mind, all this academic research was really on big data before we called it big data. We, for example, collect basically every trade on every stock in every developed market around the world, every day.
Well, let me ask you, you worked with some of your professors at Chicago.
Right.
Like Eugene Fama, for example.
Right.
And Scholes.
Right.
What influence did they have on DFA?
Well, when I was in school, I ended up working for Gene Fama, who got his Nobel Prize in 2013 and got presented papers to other professors around it. And these professors we kept in touch with, and they really helped us create Dimensional. Merton Miller, who got his Nobel in 1990, Myron Scholes in 97. It was an incredible group of people at Chicago at the time. And because the way we invest is the way they believe in, they were very helpful to us in getting started on our mutual funds. For example, Myron was our lead independent director for years, and before that, unofficially, Merton Miller was. Gene Fama was one of the founders of the firm. And I think it ties into the good side of academic work, which is try to improve understanding of how markets work. And if you can do that, you can make life better for people. So it's there's a big interest in applying these ideas because they can really help, and they have helped. Now we have over 50 years of experience, which is unusual in economic research. Usually in economic research, whatever you find, that's the last time it ever appears. But these ideas are so profound, and they've grown with time because they work.
As you say, academic research pointed out the way markets worked. In fact, the markets overall work better than individual stock pickers go.
Right.
So that moves you toward index funds.
Moves you towards broad diversification and low cost. I only bring that up because we've built our firm on the idea you can improve on indexing a bit through a better understanding of how markets work and market mechanisms. For example, or stated differently, a fundamental belief is people that are inflexible will end up losing to people that are flexible, as long as the flexibility is based on sound economic judgment. So indexing has the advantage that it tracks the performance of an index almost exactly. But to do that, you have to be rather inflexible. You have to trade at the same time everybody else is trading and that sort of thing. Whereas we go, that doesn't make a whole lot of sense. And if you have just a little bit of judgment, I'm not overwhelming, not that the kind of judgment that says this stock is undervalued or overvalued, but rather here's how the stock is trading. Can I do a better job of trading than an index fund, for example? And it was our belief when we started, and now we have 43 years of doing that. You can add just a little bit of value by using some sound judgment based on good sound economic principles. I think that's really it. Come back, get well diversified, keep your fees low, pay attention to taxes. Then you've done everything you can. And that's all you can do, is do everything you can. And one of the important things in investing, I think, is at the end of it all, judge yourself by the quality of the decision you made, not the outcome. Because these things, you can't predict these things. So just plan for it and be adaptive, and over the long haul, you're probably going to be okay.
You rely on academic research, but it's been said that over time, the way that you approach it tends to point toward value stocks and towards smaller capitalization. Right. Is that a fair description?
Yeah, that's a fair description. At some level, there's got to be some sort of connection to a risk, some sort of risk that people are trying to hedge. And we kind of think of as smaller companies are riskier than bigger companies and should have a higher average return. That's what the data showed. And similarly with value stocks, we think of those as being low price stocks. Well, the riskier the company, the lower the price it should sell at. So that's kind of the theoretical connection between size and value. Of course, it hasn't worked the last several years with the Magnificent Seven, but all these conclusions, and it's important to stress to people, whatever research comes out, whatever it points to, there's a lot of variability around the conclusion. It's rare that you come up with something that's going to work every time.
Let me come full circle back to Tune Out the Noise, the new documentary about what you've done at Dimensional Fund Advisors. What do you hope people take away from it? Well,
I hope people have a little better understanding of markets and how they work, not being dragged into all these sound good stories that don't seem to work. The feeling is if people understand better how markets work, then they'll be better able to develop sensible investment solutions and then be better able to invest at all.
That does it for us here at Wall Street Week. I'm David Weston. Join us next week for more stories of capitalism.